Welcome to the Business Broker Expert Channel. My name is Dean Wiltse, owner and partner from Curtis Wiltse M&A Advisors, representing business owners anywhere in the United States. I'm proud to have over 20 years of doing M&A and helping dozens of business owners, management teams, and their shareholders reach millionaire status through the transaction of selling their business. We're creating this channel for business owners thinking about selling their business. We'll bring you regular content regarding current business transactions, how to value your business, how to get ready to sell, what is the process for selling, and many more topics to help you. We're going to bring you up-to-date, latest information and answers to questions like, is now a good time to sell? How do you structure a deal? How do you reduce capital gains? Well, get ready. Is now a good time to sell your business? Yes, as you know, during the last few years, we've been through the highest rates of inflation, highest interest rates in 28 years, an election that was filled with turmoil and anticipation of change. And then the election was completed, and most business owners were happy with the results. But then we entered 2025, and tariffs became the next big uncertainty. Well, have no fear. That is, I'm speaking to those of you that have been in business and are business owners that have been around for 10 years or more. If you've been in business 10, 20, 30 plus years, you've seen everything, and you have results going back decades. This makes you highly attractive today. We're seeing new categories of private equity firms and family offices that have reduced their business size requirements and recognize the value of small to mid-sized businesses in almost every industry. If you have many years of experience, and if you have over 1 to 2 million plus in profit each year or more, your business will be sold in most cases in under 6 months, and you'll receive multiple attractive offers to choose from. I wanted to share with you a few quick insights from a recent Axial piece on how the recent rate cut is impacting business valuation multiples. Multiples are expanding, lifting enterprise values across the board. Floors are rising. Even good but not great companies are trading higher than a year ago. Timing does matter. Bringing deals now before supply floods the market helps lock in stronger multiples. For owners who've been waiting, this shift is meaningful. Multiples rarely go up in a straight line, and early movers often capture better outcomes than those chasing the top. You can see from the chart that businesses with 1 to 5 million of EBITDA reached a multiple of 6 times during Q4 of 2025, the highest level in over 2 years. A recent survey of business owners indicates that most expect lower rates to have a noticeable impact on deal activity. But the magnitude and timing vary. Roughly 70% of those that responded believe the Fed's recent and expected cuts will influence deal activity. 17.7% expect a significant impact, and 52.9% expect a somewhat meaningful impact. So, as you get ready and thinking about selling your business, here are the 5 most important factors to focus on when trying to increase the valuation of a business. Number 1, strength and predictability of cash flow. Consistent, predictable revenue streams significantly raise valuation multiples. Buyers and investors pay premiums for businesses with recurring revenue, contracts, subscriptions, and retainer clients, diversified customer base. You can't have any major customer concentration. No customer is over 50% of your revenue. Stable or growing cash flow over several years is really important. So our action here for you is to 1, strengthen long-term agreements and build recurring revenue where possible. Number 2, documented and scalable processes. A business that runs on systems, not the owner, is more valuable. Buyers want operations that can scale without heavy dependence on any key individuals. So look at standard operating procedures, delegated leadership structure, automation opportunities, technology that can increase efficiency. So our action here is document your processes and create a structure that allows for a seamless transition. 3, strong financial reporting and clean books. Valuation is only as good as the financial data behind it. Clean, accurate financials reduce perceived risk. So it's really important to have P&Ls, balance sheets, cash flow statements, and do those monthly or even quarterly, at least quarterly. Transparent add-backs to normalize your EBITDA. Those are the kinds of things we do to help you in preparing the materials when you're ready. We also recommend audited or reviewed financial statements. They're a credibility booster. So think about those, getting those done maybe the year before you go on the market will help you discuss those kind of things, but it's something that we recommend that you do. And then also, if you don't already have a seasoned CFO or work with a CPA, the action would be get one and start working on your financials with a seasoned CFO or a CPA to tighten up your financial reporting. And then 4, competitive positioning and market differentiation. Buyers pay more for companies with an edge that competitors can't easily replicate. So this can include a unique value proposition, strong brand and reputation, loyal customer base. Barriers to entry can be technology. Relationships are real important and difficult to break. And also regulations in your industry can sometimes be very helpful to having buyers be more confident in the sustainability of the business performance. So an action here for you would be to clarify your competitive advantage and gather data that proves it. Okay, 5, your management team and human capital strength. So companies with solid leadership teams are valued higher because they can continue to grow without ownership involvement. So consider skilled, stable management teams, clear organizational charts, incentive structures or retention plans, training programs, and succession planning. So an action here would be to strengthen your leadership depth and to minimize owner-centric operations. The cause for this increased interest in buying businesses is due to the fact that the portfolio companies of many private equity or family offices have struggled to grow in the last few years. We all know how difficult the business climate has been. They've discovered that acquiring businesses is a terrific way to grow, add people, add new product lines, increase their territory to expand locally, across the country, and even internationally. So forgetting software and technology for the moment, we've represented a mining product distributor that's been in business over 35 years, large construction company in business over 35 years, a diesel engine remanufacturer that's been in business over 30 years, and an e-commerce business in business over 20 years. From the time we've been engaged with them as their intermediary, finished developing their materials, and once we agree on a confidential go-to-market strategy and potential targets, we've been able to develop a minimum of 4 to 7 letters of intent at agreed-upon valuations or higher in 60 days or less. And that was in 2025. Buyers are out there now for strong, proven businesses. Yes, now is a good time to sell. So please like and subscribe and be notified of our next post. So thanks for watching.